What if the AI boom has a customer problem? Microsoft, Google, and Amazon are building the infrastructure of the AI economy. Investors call that unstoppable demand. But much of that demand may depend on just two companies, OpenAI and Anthropic. And here is the uncomfortable part. Those companies are not yet paying their bills from profits. They need outside capital to keep buying the computing power that creates revenue for the same companies building the infrastructure. So is this a technology revolution or a money loop that only works while the funding continues? The bullish story is easy to understand. Artificial intelligence will help companies produce more with fewer workers. It will automate tasks, improve software, accelerate research, and create entirely new products. The companies that provide the chips, cloud services, and data centers become the picks and shovels of a new industrial revolution. That promise is powerful. It is also why the largest technology companies are committing extraordinary amounts of capital before the full economic payoff is visible. But every investment boom eventually faces the same question. Where does the money come from? To answer that question, do not begin with another AI demonstration. Follow the cash. Microsoft, Google, and Amazon build the data centers and provide the computing capacity. OpenAI and Anthropic consume enormous amounts of that capacity. Investors and strategic partners provide capital to the AI companies. The AI companies then spend that money on cloud services and infrastructure. The cloud providers record real revenue. The AI companies receive more computing power. The market sees rising demand and assumes the system is becoming self-sustaining. But revenue can be real and still depend on outside financing. The critical question is whether the end customer can eventually pay for the infrastructure from recurring, profitable business, or whether new investment must keep arriving first. The market often talks about millions of future AI users. The infrastructure being built today, however, may be much more concentrated. The interview cites estimates that OpenAI and Anthropic could represent a very large share of some cloud providers' future revenue. It also argues that a significant portion of Microsoft Cloud growth has been connected to OpenAI. Those figures need to be checked against company disclosures and methodology, but the risk does not depend on one exact percentage. If two loss-making companies are responsible for an unusually large share of expected demand, then the AI infrastructure trade is exposed to their funding, their growth rate, and their ability to turn usage into profits. The story investors hear is broad AI adoption. The economic dependency may be much narrower. Imagine a bank financing a restaurant, while the restaurant uses that loan to buy supplies from a company connected to the same bank. The purchase is real, the revenue is real, but the entire chain still depends on the original financing. That is the concern behind the AI money loop. Investors fund the AI companies. The AI companies buy computing power from the cloud providers. The cloud providers report growth and use that growth to justify more data center construction. The construction then creates more capacity that the AI companies are expected to consume. This is not proof of fraud. It is not proof that the technology is useless. It is a warning that reported activity may be moving faster than independent economic demand. The key distinction is simple. Real revenue is not automatically profitable demand. The infrastructure is being built now. The profits are supposed to arrive later. Data centers require land, electricity, chips, cooling systems, network equipment, and financing. Once those assets are built, they need customers operating at high utilization for years. The interview discusses roughly 190 gigawatts of announced data center capacity and argues that the eventual revenue required to support such a build-out could be enormous. That calculation depends on assumptions about power efficiency, utilization, pricing, and timing. Announced capacity is also not the same as completed capacity, but the directional risk is clear. If AI demand arrives late, grows more slowly, or remains concentrated in a few cash-burning customers, the return on all this infrastructure can disappoint even if AI usage continues to rise. The risk is not that AI disappears. The risk is that demand grows, but not fast enough. OpenAI and Anthropic do not need to collapse for this model to weaken. They could simply grow more slowly than expected. They could delay an IPO, they could raise less capital, they could renegotiate cloud commitments, or they could discover that usage is expensive to provide while customers are unwilling to pay enough for it. Any of those events could lower cloud revenue expectations. Lower expectations could slow capital spending. Slower capital spending could hit chip demand, data center construction, and the valuations of companies priced for permanent AI acceleration. The first domino may not be a failed model. It may be a funding round that arrives too late, a contract that is smaller than expected, or a data center that takes too long to fill. There is a serious counterargument to the bubble thesis. Microsoft, Google, and Amazon are not fragile startups. They have enormous existing businesses, strong balance sheets, diversified customers, and the ability to redirect computing capacity. Microsoft reports Azure growth across a broader portfolio of services, not only one AI customer. AI demand could also broaden. Banks, hospitals, manufacturers, software companies, and governments may eventually become large recurring customers. Infrastructure that looks excessive today could become strategically valuable later. That is why this is not a story about fake technology. It is a story about timing. Will the economic value arrive before the infrastructure bill does? Investors do not need another AI demo. They need evidence. First, watch funding. Are the major AI companies moving towards self-funding, or do they require ever larger capital injections? Second, watch cloud commitments. Are customers expanding usage, meeting contracts, and paying on time, or are agreements being delayed and renegotiated? Third, watch capital spending against cash flow. If infrastructure spending rises faster than incremental cash generation, the return profile is deteriorating. Fourth, watch utilization. Are new data centers filling with diverse, profitable customers, or are they being built around a handful of strategic relationships? Finally, watch productivity. Are companies converting AI experiments into recurring revenue and measurable cost savings, or are they simply announcing pilots? One warning signal does not prove the thesis is broken. If one signal appears, reassess the assumptions. Do not blindly chase the narrative. If funding stress, weak customer commitments, and rising capital spending appear together, reduce concentration and reevaluate valuation. If those signals are joined by falling revenue estimates and deteriorating price action, the market may be moving from growth at any price to show me the cash flow. That is when investors should consider protecting capital in speculative AI positions according to their own risk plan. Not because AI has no future, but because the price may no longer compensate for the risk. The most dangerous assumption in the AI boom is not that AI has no value. It is that value will arrive quickly enough and at a large enough scale to justify everything being built today. If OpenAI and Anthropic become profitable, diversify their customers, and create enough economic value to pay for the infrastructure, the skeptics will look foolish. But if they remain dependent on fresh capital, while cloud providers keep building ahead of demand, the market may discover that it was not investing in proven economics. It was investing in a promise and sending the bill to the future. AI may be real. The economics are still on trial. Follow the cash, not the hype.